I also warmly welcome CMA President Professor Lakshman R. Vattavala, other council members, members of CMA, invitees, ladies and gentlemen. To commence the program, I have the pleasure in inviting Professor Lakshman R. Vattavala, Founder President CMA, to deliver the welcome address and introduction to today's topic. Professor Lakshman R. Vattavala has led the Sri Lankan accounting profession, have been the President of the Chartered Accountants, President of South Asian Federation of Accountants, and founder signatory to the formation of SAFA, founder of the WIT Sri Lanka, and the founder of CMA. He is currently a SAFA board member and chairman of SAFA International Relations Committee. Professor Lakshman R. Vattavala, I am honored to invite you to deliver the welcome address. Over to you, sir.
Thank you. Thank you very much, Mr. Gajendra. Mr. Puvendran Gajendra is the chairman of the Taxation Committee. He is a member of the Council of CMA Sri Lanka. And I think he has a topic which is really in great demand. So today we have our webinar on the recent developments to the tax landscape. And I must especially thank our two speakers, because they have been the ones who have really helped us and also told us that we should keep our members updated with the current knowledge. So I must thank Mr. Sulaiman, because he was really interested that we give the recent amendments in the Inland Revenue Act and also the other latest information to our members. And we are also happy that Mr. Athula Ranavira who is more practical oriented, maybe a tax expert. He is currently helping the CMA and conducting a number of tax programs for all our members to keep them updated and to get the knowledge on taxation. Actually, the interest of our webinar is seen from the number of registrations. We had 674 registrations. So I think Mr. Sulaiman and Mr. Atul Ranavira should be happy that this has shown a great interest, and also our chairman of the Taxation Committee, because this is one area that we have found that there is a great deal of interest both from our members and also those who are from the corporate sector. So let me also welcome our council members who are present here, Mr. Ruchira Perra and Mr. Asanga Vimalaratna. And let me also, I think we have our director, Ms. Shanti, who's been handling all the matters relating to the webinar. And of course, our members and the others from the corporate sector. As I said earlier, the great interest is there, and recently you would have seen that there was a special gazette notification where they had gazetted that all members of the Institute of Certified Management Accountants of Sri Lanka should open a tax file. But I know that most of you would have already had a tax file, because that's one that we always adhere to, because the ethics is a very important part of our whole profession, the accounting profession. So I'm sure not only us, but also they had gazetted the chartered accountants, but they would all be of the same caliber and standard that our ethics would want us to be. So, but that also shows the recognition that is there for the accounting profession. Because as I said earlier, the accounting profession in Sri Lanka is very much regarded overseas, especially as members of the International Federation of Accountants, which includes all the global professional accounting bodies. Sri Lanka is also in the same maybe circle of professional accounting bodies. So that's, I think, a very great thing for Sri Lanka. And today, even if you look at the International Federation of Accountants, when they were promoting what is called the SMPs, or the small and medium practitioners, one of the key areas that they have been talking is on the tax area, how they can promote and help the taxpayers in regard to the maybe carrying how their businesses could be improved, how they can be able to prepare the proper tax computations, and of course, what the Commissioner General of Indian Revenue and the government wants, of course, for each one to pay their taxes. So that's something that they have recognized, and they have seen that in all the countries, those who are practicing the tax profession are much in demand, especially in the small and medium sector. So I think government has to take a note of this, because as far as CMA is concerned, in 2014, the cabinet decided that we, as a body incorporated by an act of parliament recognized by the International Federation of Accountants, should be on par with all the other professional accounting bodies. So we have made this point to the tax commissioner also, and they will have to ensure that we are also maybe taken care, and that they also should be given the same recognition to help the large network of taxpayers who will need the services, and to approve them as approved accountants. So we have already sent a letter to the Commissioner General, and we are confident that that will also take place, but not only having our name as taxpayers, but that we will also be able to support and assist those who need our services. So as I said earlier, some of the important things that today we will discuss is, of course, on the recent amendments to the Inland Revenue Act. We have had a few seminars earlier also, and our speakers who are here, both Mr. Nista and also Mr. Ranavira, have been explaining these. But today, with the tax maybe returns coming in, they will really explain as to how this should be done. And as I said, the practical aspects of doing this would be explained by Mr. Atul Ranavira, but whereas all the thinking behind it and how it will affect the people would really be handled by Mr. Sulaiman. Then the other important area that has come up, of course, is where it is more applicable to the business sector, especially the exporters, is on the SWAT scheme, where the government is hoping to do away with that. But only thing is, we are not sure how, what alternative method that they will have in order that this can be claimed. Otherwise, they will have a severe problem, especially in the cash flow situation, which is today. With the grave situation, we will have a problem. So those are some of the important things, and I must thank everyone for coming for this, because not only members, but also the others who will be able to get to know more about the taxation, how it will help them in their returns. And of course, maybe then you maybe calculate your taxes correctly, so that you do not overpay or you do not underpay. So that, I think, is the principle that we are hoping that this our webinar will give. So let me thank everyone, and also our taxation committee, our council members, and also the secretariat for the great support that they have done to do this. And I do hope that all of you would be able to benefit from this, and also you can benefit those who are in the corporate sector, that we have our tax courses that we are now conducting. So you can also register for those, and then maybe get to know very minute details of how things could be done. Plus also where you can even register and become a certified management accountant, which will not only give you opportunities in Sri Lanka, but also overseas. So those are opportunities that are available to those in the corporate sector who have still not started on a career in management accounting. So I think this will greatly benefit them, and I do hope that you will make use of the opportunities for your career growth and success. So thanks very much, and I wish our webinar all success.
Thank you very much, sir. Next on the agenda is the presentation on the recent developments to the tax landscape. And I would like to invite Mr. Sulaiman to start today's proceeding. Over to you, Mr. Sulaiman.
Thank you, Mr. Gaziran. Thank you, Professor, for the invitation. I'll just share my screen.
Yeah, it's okay. You can do it.
Can you see my screen?
Not yet, not right now. Okay, fine.
Okay.
Fine.
Right. So thank you again for the opportunity, and let me just start off with the program today. What as described by Professor Wattavala, there have been so many changes and updates coming from the department, so we thought we'd capture all of them in one session. And the first part that I will cover would be the recent amendments to the Inland Revenue Act. Right? So the recent amendments to the Inland Revenue Act in terms of what will be effective from the budget, what was presented in last year's budget, including certain other things, have now become law. And what are those changes, how they will impact you in your returns going forward is what will be covered in that. Then there was this gazette notification that excited the whole industry, individuals like Professor Wattavala touched on it, on the registration requirement, giving specific dates where people had to register if you were affiliated to a certain body or profession or certain criteria. So we'll cover that quickly as well. That will be part of the discussion that I will have with you, as well as the recent cabinet nod or decision to abolish the SBAT scheme. So this was in the making for some time. A lot of pressure, I think, from the IMF also to have it removed. And I think finally a decision seems to have been taken, but we'll have to wait and see how the law comes through, what is the alternate method. So what we'll go into is some of the implications which will affect those who are in the SBAT scheme, as well as, what we could probably suggest as an alternate, as a discussion point will also be taken. So thereafter, there was this other circular that was issued in mid-May, that brought in the complication of how to do your computation for this year. That is the return we are going to file in November this year for the year of assessment 22-23. Now, as you know, the 22-23 return was complex in that the changes to rates, changes to certain deduction that were given earlier were abruptly changed. And for example, the 40 or the reduced rates went up to 30%. What should have happened in the end of a year assessment has happened in the middle of the year assessment. So there is a complication as to how it applies, and the department has come up with rules or guidelines as to how this should be separated between the two periods of 6 months in the case of companies, and in the case of individuals, how it will be separated based on the 9 months and the 3 months for individuals. So that part, the detail of going through that guideline and its application will be carried out by Mr. Atula Ranavira soon after I finish. Right. So moving on, the recent amendments to the Inland Revenue Act, that is the amendments that came into effect from the Amendment Act number 4 of 2023. It was passed in Parliament by the Honourable Speaker and certified by the Speaker, Honourable Speaker, on May 8th, 2023. Right. So we're highlighting here the salient features of these amendments, which most of you are probably aware of, but we'll go into it in detail. So these are the key areas that have been amended. The restriction on cash payments. So cash payments in terms of deductibility have been restricted. We'll go into that. Concessions given under enhanced capital allowances, the scope has been broadened, which is good for local businesses and those who want to expand. Dividends, there have been a lot of transitional issues with this amendment that happened last year. So how does that affect on the pass of dividend especially? We'll go into that. Refunds have been specified by law as to how much can be taken. We'll go into that as well. New and discontinued exemptions, withholding tax, BOI companies, amendments to them, and then changes to the administrative procedures. There are some significant changes that are beneficial to taxpayers in this. Right? So we'll go into it one by one. right? Right. So the first one is the restriction of payments. So there was the amendment that came that said that payments to a person aggregating to, so a total of 500,000 or more per day has to be made using cashless means in order to get a tax deduction, right? So normally our expenses, when you incur it, and it is specifically deducted under the Inland Revenue Act, for example, things like interest, repairs, which are specifically deductible, you deduct it. And then there is the catch-all condition, that is, if it's incurred in the production of income, you get a deduction. But now there is an additional restriction that is coming. Yes, you have to meet all those criteria, plus you can't pay it in cash if it exceeds 500,000 or more per day, right? So if it is less than 500,000 per day, then the deduction will come in subject to the other conditions. But if it's over 500,000 a day, then you have to make it by non-cash means, which include it can be basically paid by cash, right? So payments to a person aggregate over 500,000 rupees per day or more in relation to one invoice or in relation to one event are also subject to this rule. So one invoice and one event is also subject to the rule of the 500,000. So this excludes payments made by banks. Now, there is a definition that has been given for what a single transaction means, right? And that is a purchase or procurement of any goods or services on a single invoice, receipt, or statement, right? So what does this mean? The purchase or procurement of any goods or services on a single invoice, receipt, or statement. So if it is a payment that is for a particular event or a single transaction, which is goods or services on a single invoice, receipt, or statement, the payment, if it's connected to that, even if you break it up, will fall within this threshold, right? So the first column, if you take payment made in a day, 500,000 or more to a person, the restriction will apply, right? Payments made in relation to one transaction to the same person, right? You make it in 2 installments, for example, the restriction will apply again. Payment made to a series of single transactions, again to the same person in relation to one event, right? Even if you break it up, the restriction is applicable on that single transaction. But if it is to different persons, right? Let's say you make 100,000 different persons which are unconnected, then the restriction will not apply. So here it is a bit complicated in terms of the, so it's not just a payment of 500,000, it is now linked to a single transaction. So a single transaction is defined to mean purchase of goods or services on a single invoice, receipt, or statement, regardless of how you make the payment or how many payments you made. If it's linked to that one single transaction, then the restriction will apply. So you need to be careful how you manage your payments. If you're in a business that is significantly in cash, right? You have certain businesses that are very, use a lot of cash in their purchases, in their sales, right? So the purchases is the more risky option, because if all of your purchases, a good number of your purchases happen in cash, let's say you are in the wholesale markets, or you are in sort of areas that you pay in cash, and that's the industry norm, then there is going to be a problem, because if you're paying more than 500,000 on a single transaction, there is a deductibility issue there. So that needs to restructure your whole sort of value chain in order to get over this. And that is the whole purpose of this, is to make sure the cash economy, and that was a budget proposal, is reduced significantly. Right. The next provision, or the next amendment that came in, is this enhanced capital allowances. This is already there in our law. We provide enhanced capital allowances, but currently, so what this means, enhanced capital allowances, what it means is that normally when you acquire an asset, you get the cost of that asset as a deduction, right? Depending on the how much you get per annum, depending on the Schedule 4. Now, enhanced capital allowances gives you an additional amount. So normally you get 100% of the cost. Enhanced gives you 200, and in certain cases 300% of the cost as a deduction. If it is out in the northern provinces 300, any other place is 200, right? So this is therefore any investment made in fixed assets subject to certain thresholds that you do, that is not an expansion. So if it's not an expansion, that means you have to do it as a new project, right? Something new. But now this amendment is allowing it for expansion, which is a significant boost to companies that want to grow, right? And get this tax concession. So what will happen is for expansion, that means let's say you're in you're manufacturing garments and you have 1,000 machines, and now you want to expand it, you buy the next land and you want to make it 2,000 machines, right? But you're making the same garment, so it's an expansion of your existing business. So those, if it is an expansion, you get this 200% enhanced capital allowance deduction. So the conditions they have brought in to qualify for this is that you need to have an agreement with the Board of Investment and the expansion of the existing undertaking during any year of assessment. Right? So they're using this new term, existing undertaking, which was something that came from the previous law. It is not in this new law, if I'm not mistaken. I don't think the concept of an undertaking is there. So they're bringing this as something new now, as an existing undertaking. Now, what this also restricts is that it brings in, and it says it has to be a Board of Investment approved project. So that's where the problem is going to be for those who are not. And the question is, why the discrimination, right? So if you're going to invest and grow your business, whether you're registered with the BOI or not shouldn't really matter. You're growing the economy anyway. So the reasoning behind why Board of Investment came is I don't know what the reason is, but ideally it should be open for all, is what my view is. So anyway, this is law now. So you need to be a Board of Investment. So if someone who's not a BOI company, can you now go to the BOI company and get an agreement for the expansion that you want to do? From my preliminary inquiries from the BOI, you can, right? So the BOI is open to allowing expansion projects to take place. And then if that can be done, then if you're going in for any expansion, major expansion, which you can get this very significant claim, it's equivalent to a tax holiday, right? If you structure this enhanced capital allowance properly, it's like a tax holiday. So if you're going in for a major expansion, then visiting the BOI, seeing whether you can get a BOI agreement, because that's one of the conditions to qualify for this, and then going for the expansion may be the best way forward. So the other two, the definitions that have come in newly to support this amendment is that they have defined what an existing undertaking is. They have defined what expansion does not include. So it's a negative definition. If you just go into the existing undertaking, what it means is an undertaking conducted by a person. So what the concession is given for is an expansion on existing undertaking. So what is an existing undertaking? Is an undertaking conducted by a person prior to the first date of investment on depreciable assets, right? So before the expansion, what is the undertaking you were doing? If it's manufacturing garments, then it should be an expansion of that. Right? Then expansion does not include what? They have excluded from expansion transfer or purchase or exchange of depreciable assets of an existing undertaking of a person or an associate person. So you can't invest in assets that somebody else is already using, right? Because there is an economic activity there. What they want from this expansion, the whole purpose is to start new economic activity. So if the number of pieces of garments we want to increase, so there has to be an expansion, means it should be obviously something new. It can't be transfer of some other business in, and it can't be a replacement of your existing depreciable assets, right? So that also obviously then is not an expansion if it's a replacement. So if you have 1,000 machines, like I said, you have to make it 2,000 machines. right? It can't be replacing the old 1,000 machines. So these are definitions that have been brought in to help, I think, regulate this concession, which is a significant concession that has been given for all businesses. So again, there it's not specific to a business if you qualify, but it is fixed asset based. So if you don't have fixed assets, unfortunately, you will not get it. So the service industry may be disadvantaged here, but it is an expansion if you are investing in assets. But if it will include also in the service sector, maybe buildings and so forth will also come in depending on which schedule you take. Dividends is the next area of amendment. So just to give you the background, the dividend was not liable to tax as a withholding. There was no withholding on dividends last year, right? So the law came in and changed. The dividend rate was 14%. It was made 15% from October 1st, 2022, right? So any dividend included in, so like I told you at the beginning, this year, the year you're filing the return for in November this year, that is 22-23, you have 2 periods of 6 months, right? From April to September 30th, October 1st to March 31st, right? So up to October, from October onwards, second 6 months is October to March 31st, they have brought in a rate of 15%, right, for dividends. So if you have a dividend income, you will be taxed at 15. So the issue here is the withholding on dividend came into effect only from January 1st, right? So we have a gap of October 1st to 31st December where there is no withholding tax on dividend, but dividend is liable to tax, right, subject to exemptions. So the rate was an issue. From October to December, what is the rate we use? So there is no withholding. October is no withholding, but the rate now they have stipulated under this to be 15% for those 3 months. Right? So that is clear. Then the pass-through dividend. That means if one company makes profit, company A makes profit, they distribute it to B, right? And B distributes it to C, right? So the pass-through dividend, earlier it said that if you pay this withholding tax of 15% on the first leg, will the second and third be exempt, right? But this 15% was a new thing. It came in only from January 1st, 2023. So there can't be a situation where you have 15% in the past. So there's a whole huge exposure to all the past dividends because there was no withholding earlier, right? In the last 2 years, there was no withholding. So this condition was not met. So you're technically not falling within the exemption, meaning you're liable, right? So this amendment, what it brought in, it said, okay, regardless of the conditions, if there's a pass-through dividend, it will be exempt without any condition. So a dividend received by anyone from another person will, and you redistribute that, there will be no tax thereafter. So that clarity has been brought in from January 1st onwards. Any redistribution of a dividend, received will be exempt. Then dividend paid by a resident company to a non-resident member. So non-resident, any dividends paid was exempt till October 1st. And then there was a bit of a so dividend paid by a resident company to a non-resident member from October 1st, 2022 to December 31st, 2022 is also exempt from income tax. Here also again, there was an issue in the last amendment. There was a gap here from October to December. What happens to non-resident dividends? So now this amendment clearly brings in to say that non-residents dividend tax will only come in to effect from January 1st. From October 1st to December 31st, the 3 month, the exemption will continue on any foreign dividend that was distributed. But because of this issue that came in, I don't think dividend was distributed because of this risk in most cases. So if at all there was this exemption, will apply. Right. Then with regard to refunds, now refunds, there have always been an issue in terms of whether you can take a past year refund or not. When you put it in the return, the system doesn't pick it up. The assessors say, or the department says that no, only after an audit can you use a refund from the past. But now the law is coming with some clarity, which is good in a way, not so good in a way, where it says that a taxpayer could request to set off 60% of the refundable amount against the subsequent income tax payable by him prior to an audit of such request. So without any audit, the law itself is now permitting that you can take credit for up to 60% of a brought forward refund, right? So it brings in clarity, because all this time there was no clarity in terms of refund. The returns didn't provide for bringing forward. Now it's bringing, but it's only giving 60%. Right? So earlier, most were taking 100% because it's not refunded, not audited. You used to get assessment. So now it's clear that 60% can be taken without an audit. Of course, after an audit, it can be disallowed, but it brings in, I think, some sort of clarity. And I suppose the returns also will be amended to facilitate this. If the refund claim is less than 100,000, resident individuals are entitled to receive the refund amount due within 3 months of the refund claim prior to a tax audit. Again, as with under 100,000, you will get the full amount for, within 3 months, is what is stated. In terms of exemptions, there is a new exemption that has come in for foreign granted funded government projects. So where foreigners come and do projects, maybe things like infrastructure, water, purification, etc., which is funded from overseas, those projects will be exempted to those non-residents. And exemptions given for those projects done under the Port City Act, right? So profits of an authorized person carrying on business of strategic importance approved by under the Act. So the Port City Act will give certain exemptions to authorized persons. So that is being covered under the Inland Revenue Act. So Inland Revenue Act is also then going to be consistent with the Port City regulations and the exemptions provided therein. And then any employment income of employees also employed in terms of the Port City Act will also be exempt. So employees working for those entities within the Port City are also going to be exempt under the Inland Revenue Act as well. So certain exemptions that were there are now being discontinued. Vocational training, installation of communication towers, and bonded warehouses that were giving exemptions, they are being removed. Then an interesting section on BOI companies. There has been a bit of up and down on this, but they are bringing it for avoidance of doubt that BOI companies that have entered into a BOI agreement after April 1st, 2018, but prior to October 1st, 2022, can enjoy the tax exemption for profits and dividend as provided under the BOI agreement, or the reduced rate under the BOI agreement. So BOI agreement is a contractual agreement that is entered into by the investor and the BOI, and the BOI law provides power to override the Inland Revenue Act. Right? So in that context, the BOI is someone who doesn't, BOI agreement is not something that is burdensome. It is something that gives a concession. So if you have that concession available and the BOI agreement is valid, then taking those concessions under the BOI is what would normally be done, and that is now being endorsed by this provision that has been included in the amendment as something to avoid, as an avoidance of doubt section. So I think if you have a lower rate under the BOI agreement, that should be taken. Then administrative provisions also a significant change in the sense, if you did have an assessment for 1819 and 1920, the assessment was issued and you had only 7 months to settle the matter, or the administrative review to be done by the Commissioner General. And thereafter, if you're not satisfied that a determination is coming, you had the ability to go to the tax. So a whole lot of issues which are not even legal issues, things like withholding tax issues, all of that went to the tax appeal commission, and there's a significant backlog there at the moment. So to overcome that, I think this amendment was brought, which is very much appreciated. So I'm looking at the second bullet point. I missed the first one. I'll come back to the first one. Where administrative review is now going back to the old system prior to 1819, where the onus is now on the department. Once you lodge your request for administrative review, or your appeal, as it was called earlier, within 2 years, the Commissioner General has to hear the case and give a determination. Right, the onus is now back on the Commissioner General, where he has to give a determination. If he doesn't give a determination, then the appeal stands, right? Just like what it was earlier. So in the interim, we had a situation where within 7 months, if he didn't hear it, he would you have to go to TAC. If you didn't go to TAC, technically the appeal, you have no recourse to appeal thereafter. So on the first bullet point, the amendment is that the Commissioner General was able to amend the original tax assessment within 4 years. He was given 4 years to amend his tax assessment, which he had already raised. So that was a significant amount of time given. That has been reduced now to 30 months, which is 2.5 years. Right? So there's a reduction in the time given to him to amend his original assessment. Then filing of tax returns through the e-services platform is now going to be mandatory for all taxpayers from the year of assessment commencing from April 1st. That is running year 23-24. Right? Earlier it was mandatory only for companies. Now even individuals will have to be come on the system from 23-24. Right. So this is this famous gazette that came, notification specifying additional classes of persons required to register. Right. So I think most of us have gone through this. It says from June 1st, 2023, the date has passed. The following professionals are required to register. Right. So this is coming still under the normal registration section of Section 102 of the Inland Revenue Act. So people under the medical council, chartered accountants, certified management accountants, engineers. So all with this institute, members of these institutes, quantity surveyors, attorneys at law, those who have registered businesses, sole proprietorships, person who has a vehicle registered, acquired a movable property, employees whose monthly contribution to both employer and employee is more than 20,000 rupees, someone who has obtained a building plan, and then anyone who has income exceeding 100,000 rupees a month. So this is as at the June 1st, 2023. Say, then you move to, they've given another deadline saying by January 1st, 2023, any individual who doesn't fall in the above will have to register if he exceeds 18 years or more as at December 31st, 2023, or attains the age of 19 years on or after January 1st, 2024. You are required to register. Right? Now the question is, what does this registration mean? Right? So if you, number one, if you already have a tax file and you are filing a return, this obviously wouldn't apply to you because there are no registration to get above that. But if you are, what they're requesting is, if you have a tax file, that's okay. You don't have to register again, but you will have to get a registration if you're over 18 years from January 1st, and then you can obtain the tax type. So just because you register, that doesn't mean you have to file a return, right? You have to activate a tax type number in order to file a return. So that will be a subsequent thing, I suppose. They'll have to figure that out based on whether you have income, whether you have an asset. So they'll bring in certain criteria to obtain a tax type registration for those who are over 18, because I'm not sure if they do require everyone over 18 to file a return, whether that's practically feasible from next year, whether they have the bandwidth, whether they have the ability to do so is potentially an issue. So that's basically on what the gazette says. And the third area, I'm just going to conclude with this, is the implications of the proposed removal of the SWAT scheme. Now, the SWAT scheme, of course, has brought a significant amount of, what shall I say, significant amount of relief to the export sector, the sectors who are earning foreign currency, and whoever is the 22/7 sector, those who are where the input that you have, because you don't have, when you're zero rated only, you qualify for SWAT. The output, you don't have output, but you accumulate your input, which the department has to refund you. So the SWAT scheme, what it did was, it brought in an immediate refund. So anyone who's supplying to a zero rated person who's registered for SWAT will not charge VAT. Right? So immediately you get the refund as a result. So that was a huge boost to the cash flows, especially of the export sectors, and assisted their working capital. So removing this, right, is by the cabinet has taken this decision. Whether it will get applied or not, we have to wait and see how the law gets amended. But the major implications of this is that those who are currently enjoying this are going to have a significant working capital issue that was mentioned by Professor as well, because they are primarily exporters. And if you take what the exporters are going through from a tax point of view right now, they were at a lower rate of 15. Now they are going up to 30. So they double the income tax that they are paying at the moment, which again has affected their cash flows. Then we have had the rupee appreciating, which has again affected the rupee cash flow. And again, interest rates have been high, again affecting cash flows. And now this, so you have to now pay all your suppliers the VAT. So that's another 15% cash outflow every month. And the question is, when are you going to get that refund, right? So if you go back to the past, I can recall getting VAT refunds was a horrendous experience, because you're at the mercy of that officer and you have to go with all your files. One by one, he will look at each of them, he will find fault with each of the invoices. And then once you come to the end of the audit, the person changes, and then you have to start the audit all over again. So it's a huge issue, administrative burden. So this has to be looked at carefully before implementing. And also you run into significant amounts. You remember 200-300 million refunds were due in some of these organizations, which is something that I don't think with these high tax rates for income tax also companies are able to bear. So that is something that has been looked at. If at all it is being removed, an alternatively good system will have to be brought in, which I think should be discussed with the industry before implementing. There should be a trial run, see how well it works. And perhaps like the 60% was suggested, maybe the refund should be given in full upfront, maybe end of that particular month, the check should be drawn, and then the audit should commence only thereafter, right? Because if you're going to wait for the audit and then release the refund, it's going to be a huge burden on the industry. So giving the refund in advance, and then if there are issues in the audit, an assessment can be made and that can be taken up in appeal subsequently. So in terms of a scheme, I think it's important that the government speaks to industry and comes up with an equitable scheme. Thank you. So that's my presentation. I'll hand it over to Mr. Kajan.
Thank you, Mr. Sulaiman. Now I would like to invite Mr. Atula Ranavira to do his presentation. Over to you, Mr. Ranavira.
Okay. Good afternoon, everybody. Now, Now, Mr. Sulaiman explain the changes with relate to the recent law changes. That is in 2022 amendment, Act number 45 of 2022. Then the Act number 4 of 2023. Now, next step, what we have to do is to see how we are going to apply these things, right? Now, very recently, Commissioner General has issued some guidelines with relate to these changes. Right. Now, we will check, we will go through those things. Now, in addition to that, as Mrs. Suleiman also explained, there are some, these changes are specially affecting to the year of assessment 2022-23. Now, as in what has happened in 2019-20 year, in between the year of assessment, government changed various things. This time also, most of the changes which relate to the individuals are effective from 1st January 2023, and some other changes, mainly the changes which relate to companies and other entities, are effective from 1st October 2022. Now, with these changes, when they change in between a year, when we are filing the tax return for that particular year, we have to be more cautious on how these figures are to be apportioned to two different periods. Now, what has happened by the Amendment Act number 45 of 2022, they brought a proviso to the Illa Revenue, to the section 120 of the Illa Revenue Act. Now, the section 120, the heading of that section 120 is accounts and records. How to prepare the accounts and records for the purpose of the filing of tax return, for the purpose of tax calculations and filing. Right. Now, in that, I would like to share a small document. I have prepared a small document with relate to this apportioning of profits. I will share one document like that. I think you all can see this document. Right. I'll increase the letter size as much as possible.
Yeah, okay.
This is an Excel sheet. On an Excel sheet, I have typed. Yeah, that's the maximum what I can. Now, this section 100 in this document, this is a bottom of a document which I have prepared. This document, if you go to the top, this is a template of tax calculation of an individual. Individual's tax computation for the year of assessment 22-23, a template. This is an Excel sheet. We can insert these figures into this Excel sheet and get the answers. Now, this when there are schedules like this, there are some attached schedules to this. Anyway, first I'll explain this bottom note, what I have given. Now, I have extracted this section 120 and given here. The section 120 talk about the preparation of accounts with relate to the business or investment activity. Section 120, it says, 1, a taxpayer engaged in business or investment activity or required under this act, in addition to that, required under this act to make a return shall keep and maintain in Sri Lanka records and accounts sufficient to record all transactions, and to ascertain the gains and profit made or loss incurred in respect of those transactions. That means now when we are engaged in a business or investment activity, we are supposed to maintain sufficient records and accounts to record those things and fill the tax return. Now, into this section, subsequently they brought another through 2021 amendment. They brought another amendment to this, saying as section 121A. This 1A, this is a proviso. I didn't give that 1A. The 1A talk about the year of assessment. Any year of assessment commences in 1st April 2021. How to maintain these accounts. Then with this the very recent amendment, that is the 2022 amendment, they brought this proviso into this. This is a proviso. Now section 120 subsection 1A, that is 2021 amendment item, to that they brought this proviso in 2022. According to this proviso, if we'll read this proviso, that is the recent amendment, it says, provided, however, now this is a continuation of business and investment activities, right? Provided, however, in the case where such person has commonly incurred expenses, or commonly used any asset, on all business or investment activities, and any expense or deduction cannot be separately identified. That may be difficult for you to identify it relating to which one or which period. For the purpose of this subsection, it shall be lawful to divide such expenses or deduction on a proportionate basis. Now, if that means you are permitted to apportion that on a proper proportionate basis. Then within bracket, it gives what are the bases. Accounting to proportion of turnover. That means on the turnover basis, you can apportion. Or proportion of asset usage. Suppose it is allowable depreciation, that is capital allowances. If it is capital allowances, suppose that particular machine is using for 2 different productions or 2 different industries, then you can apportion according to the asset usage, like machine hours or something like that. Now, if that expenditure is directly connected with an asset, you can divide that on the basis of asset usage. If it is not, then you can divide that according to the turnover. The law recognizes these two bases recognized by the law. Now, when we read this, we can apply this section even for 2 time periods even. 2 time periods even. Now, when we take the year of assessment 22-23 year, if it is a company, there are 2 time periods of 6 months and 6 months. From 1st of April to 30th June, again, the second period from 1st of October to 31st March. In the case of an individual, it is first period is 9 months, second period is 3 months. First period from 1st April to 31st December, the second period from 1st of January to 31st March. 2 periods are there. Now, we can apply this basis, to apportion our expenses according to these two time periods or asset usage, then time period. Now, according to this, what it says, either turnover basis or asset use. This is, I just included this as a guide. Then very recently, that is on 9th of May 23, Commissioner General published a circular with relate to the year of assessment, 22-23 year of assessment, how to apportion these things, various things, not only these expenses, but also qualifying payment, the reliefs and all these things, and prepare the accounts. Now, I think majority of you all may be having that document, but after this session, we can share that particular document also along with these presentations. Right. Now, according to that circular, I'll close this and open that circular. Then it is easy for us to understand. Yeah. Yeah, I'll share that document also now. Yeah. Yeah. Sorry.
We can see now.
No, not that. Yeah. I think there's an issue of sharing that. Right. I'll explain. Now, in that document, what it says is that is a circular number 3, E3 of 9th May 2023. In that document, it says, how to apportion these time periods for individuals separately and the companies separately. For individuals separately and for companies separately. Now, in that, in the case of individuals, it says individuals' first period should be 9 months and the second period should be 3 months. Then in the case of individuals, the employment income, investment income, and other income. Employment income, investment income, and other income has to be on actual basis. That means you have to, now employment income, no problem at all. We can identify the actual employment income related to the first 9 months. That is not at all a problem. But then investment income also we can calculate like that, first 9 months actual. Then the other income, if there are, we can. Then it says business income, included business income should be on a pro rata basis. Now, pro rata basis, then within it says 75% for the first period and 25% for the second period. Or on actual basis. That means Now, there are 4 types of income. Out of those 4 types of income, employment income, investment income, and other income, you have to apply the actual basis. First 9 months, actual amounts, balance 3 months, actual amount. But only in the case of business income, you can apply a pro rata basis or actual basis. Now, this pro rata basis, how to calculate the pro rata basis? Now, the pro rata basis, as we read in the section 120, you can calculate based on the either the turnover, or else you can apply on the time period. Right? That is the asset usage period, asset usage. Now, if it is something to do with the asset depreciation, then best thing is to asset usage, to apply asset usage on that. Right. That is how, that means now when we are preparing our personal tax return, we have to apply like that. We have to apply like that. Right. Then, in the case of companies, first we'll see a company computation format. Now, this is a computation format. I will increase the letter size as much as possible. Yeah. I think you all can see this. Yeah. Now, this is a template with relate to the companies. Now, companies, when we are preparing company tax computation for 2022-23 year, we have to take first 6 months separately and the second 6 months separately. Now, in this template, the employment income not applicable for companies. Then the business income, I have divided here on the turnover basis. On the turnover basis. Right? On the turnover basis, I have divided. Or else you can divide on the actual basis. Now, suppose application of actual basis is better for you. Now, you can apply the turnover basis separately and the actual basis separately. The non-fact is first 6 months, the tax rate is lower than the second 6 months tax rate. The first 6 months, first period, the tax rate may be even maybe 14%, 18% or 24%. But second period, it is flat 30%. Therefore, it is always advantageous for us to load as much as possible into the first period. Legally, within the law, load as much as possible into the first period. Therefore, my advice, of course, now this business income, you apportion on the turnover basis and see, then on the time period and see, then in that way, you can see what is more beneficial. What is more beneficial? We can apply that most beneficial system. Because in the case of companies, this circular, it says the business income included under the taxable income could be separated into 2 periods by using pro rata basis or actual basis. Now here, the pro rata basis, you can apply the turnover basis and see. Once you apply the turnover basis, our ultimate aim is to load as much as possible into the first period. Right? You apply the turnover basis, then the second method, just 50% into the first period, 50% into the second period. Out of these 2 methods, whichever the method beneficial to you, you can apply. No issue about that. Then, if there are any business losses, now there's an issue. Now, there may be brought forward business losses. Now, when we see the section 19 says claimable losses has to be claimed. If there's a claimable loss, you have to claim it. You can't just wait without claiming. I'll read those wordings in section 19 because knowing that only we should apply it. It says, in calculating income from a person, from a business, for a year of assessment, following shall be deducted. Unrelieved losses of that year or the brought forward unrelieved losses from another business or from brought forward. That is one thing. Then second, it says the person may choose the income calculation or calculations in which an unrelieved loss or part of the loss deducted. However, where a loss can be deducted under the subsection 1, it shall be deducted. Now, as an example, by the time we were filing 2021-22 return, we knew next year, 22-23, the tax rates are going up. Then, at that time, we would have thought, better not to claim the losses in that year, just carry forward and claim in 22-23. That you can't do. As per the law, if it is claimable, you have to claim. You can't postpone it. But now here, the issue is same year of assessment. What you can't do is wait without claiming during that year of assessment. But here, in the both this once we add through periods, it is the year of assessment. Summation of these two periods. In that case, my advice, of course, better to claim this loss in the second period, because it is more advantageous. Now, the law is silent on this matter. Always, if there's a doubt of the law, any benefit out of the doubt of the law should go to the taxpayer and not to the tax authority. Now, as it is not clearly mentioned in the law, this losses, claiming losses, it is not clearly addressed to with relate to this particular year of assessment. Therefore, my advice, of course, instead of claiming in first period, better to claim in the second period. Okay. Then I'll move to investment income. In this circular, the investment income, it says investment income and other income included in taxable income shall be separated into two periods on actual basis. Their only option is actual basis. Right? There you can't apply any other basis. Therefore, in investment income, it has to be actual basis. Right? You don't have any other basis. Right? Then I just, for education purposes, I mentioned here as actual. What I have done, that year's total interest income, out of the total interest income, the interest income relating to first 6 months, I have taken into the first period. The interest income with relate to the second 6 months, I have taken into the second period. Now with that, there was a higher interest amount in the first 6 months. If this actual basis is not specifically mentioned in this circular, we could have to divide this 360,000 total amount into 2 periods at 180,000 each. First period 180, the second period 180. If we have done, we would have enjoyed we would have saved some tax, right? We would have saved, no, this method is, in this case, this method is better. Because second period, the actual is less. Therefore, actual method, the circular basis is beneficial to us. Suppose this was in the other way, 260,000 in the second period and 100,000 in the first period. If we were permitted, just divide 6 months, half and half, it would have been beneficial to us. Right? Anyway, these are the bases what we can use. Then we'll move to claiming of qualifying payment and relief. Now we got the total assessable income. First period, second period, total assessable income. Once he arrived this total assessable income of the first period and the second period, from that to arrive the taxable income, we are supposed to deduct the qualifying payments and relief. This being not an individual, this is not an individual, a company. Therefore, we have no reliefs available. For individuals, only relief available, qualifying payments. No personal allowance, no employment allowance earlier thing, then repair allowances, the relief on earlier we had expenditure relief. None of these are available. Reliefs are not available for companies. Then qualifying payments are available. Now in this case, in this scenario, there's a qualifying payment of 250,000. What I have done, 230,000. What I have done, I claim the qualifying payment from the second period, not from the first period. Qualifying payment, I claim from the second period. Right. Then, once we do like that, it is more beneficial to us. Claiming of qualifying payment in the second period is more beneficial. This circular says something like this with relate to the qualifying payment. Qualifying payments are deductible either from first period or second period or from both periods. Because Commissioner General also has recognized that it is not explained in the law. As it is not, apportioning method is not explained in the law. As it is not explained in the law, he has mentioned that we can select the period. That's good. Right. Now, because there's a doubt of the law. When the doubt of the law, the taxpayer can select the better thing. Right. Therefore, better to claim the qualifying payment from the second period. That is what I have done. Then once we deduct this amount, we are getting the taxable income. We are getting the taxable income. Once we get the taxable income, we have to calculate the taxes. Now this is a calculation. Now actually this format is a format what we were using in our office, and to that format, that template, we have added, newly I have added these 30% two brackets. These last two items I added newly. And this second column, two columns, I have added newly. Now, then, first period, there's a taxable income of 318 million, second period, 71 million. Now, the first period, this is an export-oriented company. This the sample, the scenario is with relate to an export-oriented company. Therefore, up to 30th September 2022, we were enjoying 14% tax rate on that. 14% tax rate on that. Therefore, on this 318,204,000, I have calculated at the rate of 14%. Right? Then, the second period. Now, first period, in addition to that, no, not 318,464,000 out of this, the composition, if we'll see the composition of this, it comprises two items. Business income of 318,204,279, investment income of 260,000. Business income being an export-oriented company, we can enjoy 14% lower rate. Then on investment, we have to apply the earlier 24%. Right. That is why I have put this 260,000 under 24% bracket. 260,000 interest income, 24% bracket. The business income portion of the first period at 14%. Then first period is over. Now we will move to second period. Second period, we have 71,298,000. That comprise with two items. One is a business income. The other portion is the business income and investment income. Now what I have done, we have deducted the qualifying payment. That qualifying payment, I didn't deduct the qualifying payment from this 100,000. I deducted that qualifying payment from the business. Now in the second period, of course, either is all right. You can deduct the qualifying payment from investment income or business income. Now in this, because again, the tax rate is anyway 30%. There's no harm. Now what I have done, out of this 71,298,000, 100,000 investment income, I took 30% separately, and the balance amount, I took 30% separately. Ultimately, both are 30%. Right. Now, then second period total tax amount comes to 21,389,000. Then once you add these two together, it is the total tax. Now, from this point onward, if we wish to, we can combine these two columns and continue the balance part. Or else, we can have these two columns separately. Now, first period amount, now as per this scenario, there was a ESC claim during the year, 200,000. I claimed that ESC from the first period. Then during the first two quarters, we had paid 5 million. I deducted that 5 million from first column. Then for second, third and fourth quarters, we had paid the 6.3 million. I have deducted that 6.3 million. Then I'm getting the balance tax payable. As I have continued, these two columns therefore, the balance tax payable for the first period and the balance tax payable for the second period, I have taken separately. Okay. Then, if there are any exempt income, we can apply the taxes on we can show the exempt income separately, because in your tax return, you are supposed to show the exempt income separately. Now, as an example, in this company, there's agro farming income of 315,000. Then there's a consultancy, overseas consultancy income. Overseas consultancy, export of consultancy services, 900,000. Both are tax exempted. Now, in this case, whether it is first period or second period, either case, no problem. It's a matter of showing those income, exempt income in our tax return. Okay. Then, as I was explaining earlier, this section 120 and 121A proviso, I have given for as an educational material. This was not there in my template, but I added this subsequently. Right. Now, I will move to the other slides. I'll move to the other slides. Give me a minute, please. Right. Yeah. Yeah. Now, in this template, other workings are also, all the workings are there. This is the tax computation page. This is the tax computation page. Yeah. Right. Now, yeah. Then this is the adjusted profit for taxation in this template. All these things are there. Those are linked to the main schedule. Now, in this, to prepare the tax computation, we have to get the adjusted trade profit, taxable profit, adjusted trade profit, 497 million. That is the amount which is divided into two columns of this. In this, it is the amount divided into these two columns, right? Now, in this, normal adjustments, we need not to have two columns. Now, if we are separating based on the turnover, we need not to have two columns. But if we are applying the actual basis, you have to have two columns in this also. First 6 months separate column, second 6 months separate column. Even for business, if you are applying actual basis, yeah, even this computation of adjusted profit for tax, you have to have two columns. But I didn't do that because I took the turnover basis divided into the based on the turnover, right? Then this includes all schedules also. It includes all schedules also. Now, all these figures are copied from the schedules. We don't have much time to explain all these things, but the basic recent changes part only we are covering. Right. Now, in this, for retirement benefit, it is not applicable. The retirement benefit obligation, the breakup is there, and legal expenses, foreign travel. Likewise, all the breakups are there. Allowable depreciation, everything is there. Right. Anyway, what is important for today's topic is the tax computation part. I'll close this particular document. I'll close this particular document for the time being, right? Then, in the case of individuals, we'll see how we should do the individuals' tax computation. I'll share the individual's tax computation part also. Yeah. I'll share that document now. Yeah, this is the individuals one. Now, individuals tax computation, they are now we can fill the name, TIN number, tax computation, income tax computation, year of assessment 22-23, right? Letter size, of course, little bit too small, right? Then in this also we have divided into 2 columns, first period of 9 months, second period of 3 months. Then I have put a total column also. Now assessable income from employment as per this Commissioner General circular, you have to apply the actual basis. Then first 9 months remuneration here, second 3 months remuneration here. Then assessable income from business, either you can divide into on the basis of the turnover, or 3/4 for the first period and 1/4 for the second period. Now here I have applied based on the number of months. The total income 900,000, I divided by 12 and multiplied 9 and taken for the first period. But if it is on actual basis, you apply the actual basis and see which is more beneficial. If actual basis is better, now here I have taken the time period as the base, but if actual is better, you better use the actual one. Because the second period, that you have to minimize the second period income. Then only you are benefited. Then investment income. Investment income, I have taken the actual basis. Now, investment income, like salaries, easily we can identify the actual income. Then the first period, total 9 million. Second period, 2.9 million. Total for the year, 12 million. Then the calculation of tax, as we know, the first period we are applying the old rates, 6%, 12%, 18%. Then the second period we are applying the new rates, 6%, 12%, 18, 24, 30, 36%, and arrive the tax amount. Right. The tax, that is the calculation. Before calculation, the relief. How to deduct the relief? Now, relief, as per the circular also, the Commissioner General says the tax-free allowance, that is for the first period, 3 million divided by 12 into 9. Therefore, you can take only 2,250,000. Second period, 12 million divided by 12 and multiply by 3. You are eligible to claim only 3 lakhs. You can't claim different amounts. Then relief on rent relief, based on this rent income, if you have any rent, based on the rent income, you are taking. Out of the rent, what we have included here, rent amount 25%, you can take. Then expenditure relief, as we know, up to 31st December 2022, we had an expenditure relief. But for the second period, you can't claim. Why? The second period, there's no expenditure relief. Therefore, whether you like it or not, you have to claim it in the first period. Then on solar panel cost. Now the solar panel cost, fixing of solar panels on your premises roof and supply into the CEB, you are getting 600,000 rupee deduction per year of assessment. Now we will see this 600,000 we incurred in the previous year, and the previous year we claimed something, and this year we are claiming 600,000. Now this 600,000, see, I have claimed in the second period. I didn't claim in the first period, entire amount I claim in the second period because it is more beneficial. Second period taxable income, we have to minimize, get it minimized. For that, to facilitate that, I claim that in the second period. Even the Commissioner General's note, this circular, it is allowed because there's a doubt of the law. When there's a doubt of the law, the benefit should go to the taxpayer. That the Commissioner General also has recognized. Then next, the donations, if there are any qualifying payments, donations, even these donations or whatever the qualifying payments, we can claim the entire amount in the second period. It is more beneficial. That I did. I claim in the second period. Now I got the taxable income for 2 different periods. Once we get the taxable income, first period taxable income, we are applying 6%, 12%, and 18%. Arrive a tax amount of 500,000. Then second period taxable income, I'm applying 6, 12, 18, 24, 30, 36% and got a tax amount of 454,000. Then the total is the total tax amount is the total of these two, 954,000. If I have not given this 600, if I have apportioned this 600,000 also into 2 period, even this qualifying payment into 2 period, this the ultimate tax amount would have been more than this. Right. Then once we arrive the total tax amount, we can deduct. Now from this point onward, I have taken as 1 period. From this, I have deducted the APIT payment, non-final withholding tax, interest on the withholding tax on interest and all these things. I have deducted 214,000. Then I have deducted the quarterly payments of 400,000. Then I have deducted the final payment, that is 30th September payment of 340,000. Then that is the total amount. Ultimately, there's no balance tax because we have prepared this tax computation before making the final payment. As a result, no further tax to be paid. Then if we, as in the companies, if there are any exempt income, we have to show the exempt income separately. Right? Now, even in this tax computation, I don't have now I think I have taken 5 minutes extra also. In this tax computation also, in this template, the assessable income from employment, separate schedule is there for that. Assessable income from employment, there's a separate schedule. Then assessable income from business, there's a separate schedule for that. Then assessable income from investment, there's a separate schedule. Then there's a separate another schedule for this taxpayers' assets and liabilities. Because when we are preparing the tax computation, we have to fill the assets and liabilities. Therefore, in our tax format, we are including these assets and liabilities also as a note. I think I have explained the application of, the other thing is the partnership. With related to the partnerships, I didn't include the partnership computation here. With related to the partnerships, first period, they had withholding tax of 8% on the divisible profit. Right now, the second period, they introduce income tax on partnership, 6% income tax on partnership. There, when we are calculating the first 1 million at the rate of 0%, anything excess of 1 million, we are supposed to calculate 6%. Therefore, even in the partnerships, we have to prepare 2 columns for 2022-23 year. Okay. Yeah, with that, the other thing, this particular circular and these formats, I will share through CMA Secretariat. thank you. Now the balance time we can go for question and answers. I'll stop sharing this.
Thank you very much, Mr. Ranavira, for your presentation. Now we are moving to the question and answer session, and we ask participants to send your questions through Q&A. So before moving to the question, I would like to ask whether Mr. Asanga or Mrs. Sureka, you have any question to be asked from our panelist?
No, I am fine, Rajit. No, I am fine. Thank you.
Okay, so Mr. Ranavira, there are a lot of requests for the slides. I think we can share it to the members as you agreed.
Yeah, we can do that because this is a template, this is a common template what we are using, and it will be helpful, especially the individuals who are doing their tax on their own, as well as the people who are involved with taxation of other people. We'll do that.
Okay, then we'll take the questions wherever possible. The first question is, I would like to answer from the presenters that you have mentioned, Mr. Ranavira, that employment income need to be taken on a cash basis or actual basis for
It says-
individual.
Yeah, actual basis, yeah.
So they are asking what is the situation of a bonus if it is paid for the year and if it is paid during February, whether they have to take it for the second period or they can divide.
No, in the case of bonus, now this issue is there with relate to the withholding taxes also. Now we are the APIT. Now, when we are deducting the APIT on bonus, we have to deduct the APIT on bonus at the time of making the payment. But the word payment is defined in the Inland Revenue Act, which is totally different to the normal dictionary meaning. Now, as per the definition of payment, given in the Inland Revenue Act, in section 195, it says, actually it indicates, though the word payment, now when we hear the word payment, it looks like actual payment, but it is not the case. Now, as per this definition, it says the transfer by one person of an asset or money to another person, or the transfer by another person of a liability to one person. Like I said, keep on explaining. Now, by reading this, it is on, though the word payment, it is on accrual basis. What's the time you give the right to the other person? Therefore, even in the case of bonus, what we have to see is the decision of bonus. Now, the entitlement, when I am entitled for a bonus. Now, just because as a practice, we'll say I'm working for a company, as a practice, every year they were paying 2 months bonus in December or 2 months bonus in April. After the year, they are paying in April. That is the practice. But I'm not entitled to that bonus until the management taken a decision on payment. That the decision date, the decision date should be the date for this payment. Therefore, that decision date, based on that decision date only, we have to decide whether the APIT to be deducted on which date. Now, this is happening now. Sometime 2022-23 year profit, bonus is declaring after preparing the account somewhere around April, May, June 2023. But it is calling as 22-23 years profit bonus. But it is declaring in May 23. Now, in that case, it is taxing in May 23, right? The APIT to be deducted in May 23, not in the previous year, right? Likewise, Now we have to see this particular, now suppose it has happened, now we'll say as a practice, every January they are paying a bonus. And this year also, they announce a bonus in January. Then we have to take that bonus into second period of 3 months, January 23, right? Not even it is, the bonus is based on the profit of the first 9 months, you didn't have an entitlement, right? Therefore, you have to take that into the second period for APIT purposes, as well as for splitting of this income. You have to take that into the second period. I
Okay,
think I
thank
have answered that question.
On the next question is on the, they ask referring to a January to December year income. They are maintaining the accounts for January to December. So they are asking how this 30% is going to affect only for the last 3 months, that is October to December or June to December.
No, it's like this now. As per our Inland Revenue Act, nobody is permitted to change the year of assessment. Year of assessment is always fixed. Nobody can change it. What we are changing then? What we are changing is the period covered with that year of assessment. The year of assessment is fixed. Then what we are changing is the accounting period covered with that year of assessment. Now, due to various reasons, some companies, they may be having January to December accounting period. Then in that case, now January to December is recognized. Now, for this question, I think a bit difficult to answer this question, but I think now if we have got the approval for January to December accounts, then if this particular transaction occurred during the first 9 months, that is on or before 30th September, on or before January to 30th September, then we have to take that transaction as the first period one. Suppose that particular transaction happened in the second 3 months, that is October to December 3 months, then I think we have to, it is fair for us to take that into the second period.
Next question is dividend paid out of dividend received is still exempted.
Yeah, continue to be exempted.
Is the withholding tax charge on interest payments of overseas loans?
No, it's exempt. No, still. What was removed is the dividend. Dividend was exempt, now they made it liable. Foreign loans, the interest is still exempt on the foreign recipient.
Okay. Next question also, I think, on the Sulaiman.
Yeah, that is because of this Schedule 3 that is exempted.
Okay. Next question also, I think, from the Sulaiman's presentation. Yes, I think it's from 1st January 2024, not 2024, over 18 years.
Yes, 24, correct.
Whether dividend distributed using exempt income, foreign source income, is liable to pay dividend tax at 15%.
No, redistribution is exempt. So if it's out of dividend received, the exemption will continue.
To Mr. Sulaiman, is the new individual tax registration and tax declaration applicable only who consider under residence category or non-residents citizens who live in foreign currency as well?
Yeah, so the requirement is if you are registered with one of those, if you fall into one of those criteria, you have to register. But if you are not liable to the tax type registration you can avoid, right? So as due to your non-residence, if you're earning outside, but the initial registration is required if you fall within one of those categories is my take on it, because in the absence of a specific guidance.
Then there's a
Mr.
question.
You have another view? Mr. Ranavira, you have another
view? I'm totally agreeable with you.
Yeah, so for example, somebody I think had put a question where if they're working in the Middle East, let's say Dubai, they are a member of the institute, or it's a CMA, been there for 10 years, no income from Sri Lanka at all. Do they have to register? They are still keeping the membership going. I think you can't get out of the initial registration, but on the tax type, you can probably avoid filing a return perhaps.
And there's another question. What are the penalties for one not registering a TIN and not submitting a tax return?
I think it's a criminal offense also. No? There's a
Yeah.
50,000 amount is not so big, but I think it's an offense if you are
Yeah.
supposed to file and not file, and there is a jail term also.
But recent notices issued by the Commissioner General on by the commissioners for the non-submission of return, they are referring as a penalty of 1 million.
Failure to
Have
furnish a
they,
return.
have they issued like that?
They send a letter to submit within 15 days, so they will file an action of impose a fine of up to 1 million.
Failure to furnish a return, I think I can't recall it being so high, but we'll check and see.
Yeah.
Okay, then,
But it is an offense. It is an offense, and there is several penal provisions. Yeah.
so then there's a question. I own a car. I am required to register after 1st June 2023 to obtain a TIN. I am currently traveling overseas, hence unable to register online as I do not have the required documents with me at present. Before when do I have to register? Is there any deadline?
So 23 is the deadline, June 1st, 2023. Online can, right? Even if you're abroad, you can register from.
Yeah,
abroad.
but the person mentioned as they don't have the required document. Maybe, but I think only required documents is the NIC, you know?
Yeah.
So
For
they
the
might
initial
even
one, from abroad,
ask
you
somebody
can-
to scan and send the NIC, then he can do it.
Correct.
Is
No, that person himself can do
Yes.
that
Yes.
because there's an online registration.
is that all of them only individual for the tax refunds on new amendment?
Sorry, what was that?
They're asking, is that all of them, or that mean even corporates only for individual for the tax refunds on the new amendment?
All. It's any person. The 60%, right?
Yes, they didn't mention. I think that's a country.
Any
I don't think
person.
it's any person.
For individual cases, first 9 months and 3 months tax return only for those becoming liable to pay tax, isn't it? But I think whether you have to file only one return, no?
Only one return.
What can be done if the second 6 month is a loss? Can it be net off with the first 6 month profit?
That the guideline, I think, specifically says you can't. There's a specific mention, I think, Mr. Anavira.
Yeah. It says you can't.
You can carry that forward to the next year, but you can't bring it back, is what they have said.
I don't
Is
know
it-
how, whether it is legal or not.
Yeah,
because
that's
they're
true.
allowed, because
Yeah,
by
because the
the-
year of assessment, right? You make it for, yeah. So you should be able to shift, but then this guideline has come, and so we are kind of bound by it. But yeah, that's the issue.
And someone asked whether SSCL can be deducted from as expenses. SSCL.
Yes.
Yes.
For income tax purposes, you can.
Is it necessary for senior citizens to register for tax?
Yes, no exemption. If they fall within the criteria.
How about liability on software development companies from 2023-24 for local projects income and foreign project income?
So local is liable. Foreign, if they are meeting the conditions of utilized outside Sri Lanka and foreign currency being remitted through a bank, that part will continue to be exempt.
Business loss can be deducted the second period without setting off the first period. As per section 19, deduction of the loss against business income is mandatory. They're asking the first period without, I think you explained that, no, we can skip the first period and claim it on the second period.
Yeah, that we can do, because that is now what you can't do is skip the year of assessment.
Yeah.
Right. Within the year of assessment, you can pay it. No problem.
Yeah.
Can non-BOI companies claim 200% capital allowance on branch expansion?
No, they have to get a BOI. That's one of the conditions to get a BOI registration for some unfortunate reason. So, like I mentioned, you can get a BOI agreement for expansion. If it's big enough, it's worthwhile doing it.
Is it possible to deduct solar deduction from employment income?
No, right? So I don't think.
No, I think that question now, suppose you are having only the employment income,
Yeah, correct. Yeah.
then the total assessable income represent employment income. That's okay. But this deduction is a deduction from assessable income in arriving at a taxable income. Therefore, you are eligible to deduct. You are eligible to deduct the solar qualifying payment from the assessable income, no problem. But only thing, your employer will deduct the
Yes.
capital loan.
Yeah, you'll claim a refund then. Huh?
Yeah.
Doesn't it get excluded? No.
No.
Yeah, just like those qualifying payments we had earlier, no? Yeah, you'll claim a refund.
Another headache.
If rent advance is paid for 36 months in January 2023 and withholding tax deducted, how many months rent should be recognized for 22-23?
The 12. Sorry, in 36 months they've got advance, is it?
Yeah, so January to March in the only 3 months, no?
Yeah, only 3 months. Because the balance amount is a receipt in advance, no?
Yeah.
Now, for withholding tax may have deducted, but for tax, the ultimate assessable income, only those 3 months income to be recognized.
When will we know whether someone who registered with IRD will need to file a tax return or not?
When is already stipulated, right? So
yeah, so he says he registered online that under the tax registration.
Okay.
So he want to know when he can know that he need to file the return on.
That is there.
30th November.
30th November, yeah.
So he should get a return. He should file the return now. Since online, he'll have to, onus is on him.
I think since we are coming to an end, it's time to invite our president to do the concluding remarks.
Right. Thank you, Mr. Gajendra, and also our valued speakers, both Mr. Sulaiman and also Mr. Atul Ranavira, because I think you have refreshed the memories of everyone, because sometimes some of these things people get excited at the time that is given, but then after that they tend to forget. But now I think with the various amendments they have made, I'm sure that most of these things can be cleared up. But there seems to be still quite a lot of doubts and clarifications. I can see almost 47 either comments or clarifications that they have sought. So it may not be possible to maybe answer each and every one, but on the whole, I hope that you'll have been able to get the full meaning of what was really given in the presentations. So I'm sure that all our members would have benefited by this. And as I said earlier, that maybe if you want to maybe get more thorough knowledge, it is very much better. So that's why we have started our programs which we are conducting. So you will be able to get the details from Ms. Shanti for this, and also we circulate all the members so that they can attend these programs also. In fact, I saw some question as to whether someone was saying whether we need to maybe make ourselves knowledgeable in this sort of thing, because the thing is, once law is passed, we are liable, so we can't avoid it. So it is best to be knowledgeable about it rather than blame others. I'm sure some of these may be the mistakes of others, but as far as once the law is passed, the citizens of the country are liable to pay the taxes. So that's why the tax experts, the accountants, who are required to support the society in preparing their tax computation. So I'm sure the two tax experts who are here, both Mr. Sulaiman and Mr. Atul Ranavira, are always available for you all to maybe answer any questions or clarifications we have, or the chairman of the tax our committee, Mr. Gajendra, who should also, you can also contact him so that they can also support you in all these matters. So once again, let me thank our speakers, because it is always good to have, I think I would like to tell Mr. Gajan that once in 3 months, if you can have a webinar on taxation, because that will help all our members and also the others from the corporate sector, maybe to get more knowledge and updates, so that will help. Plus also, I think maybe we can also find out about the collection side. I don't think that we mentioned anything about it, but maybe in the papers, we have seen that their collections have gone up, and also that they are close to achieving the targets that have been set. So that's also important to see whether how whether the collection mechanism is happening and how it is being monitored and controlled. So once again, let me thank our speakers. I said earlier, both Mr. Sulaiman and Mr. Atul Ranavira, and our tax moderator, and Mr. Govindran Gajendran, all our council members, and also our members and other participants. And definitely, I do hope that this should have helped them. But if you have anything, you can always contact our tax committee chairman, Mr. Gajendra, who will be able to help you in any matters that are there. But if you need expert knowledge, I'm sure you will have to consult a consultant and get their support services on this. So once again, let me thank everyone, and we will be continuing our professional programs. As was mentioned, CPD is very essential, especially for the professionals as well as all the others, so that you will get updated on your knowledge. And although we are going through difficult times, things have now seem to have settled compared to what it was earlier. So we do hope and wish that things should improve, and all our members and others should be able to gain by it, and also the citizens of the country. Thank you, and all the very best to you.
Thank you. Thank you.
Thanks.